In computing for consolidated balances on acquisition date, this memory aid may come in handy. That's Carla 23434. C stands for consolidated common stock. A stands for consolidated APIC. R stands for consolidated retained earnings. L stands for consolidated total liabilities. And A stands for consolidated total assets. The numbers indicate the number of items that you need to consider. For consolidated common stock, you have to remember two things: common stock of the parent plus common stock issuance at par value. For consolidated APIC, you need to remember three things: APIC of the parent plus APIC from issuance of shares minus share issuance costs charged to APIC. For consolidated retained earnings, you have to consider four things. First is the retained earnings of the parent. Second, we need to deduct direct and indirect acquisition costs. Third, we also deduct excess of share issuance costs over APIC, if any. And lastly, we need to add gain on bargain purchase. For consolidated total liabilities, you need to remember three items. First is the liabilities of the parent at book value. Next is the liabilities of the subsidiary at fair value. And third is liabilities issued. For consolidated total assets, we need to remember four things: assets of the parent at book value plus assets of the subsidiary at fair value minus cash paid for consideration and for acquisition-related costs, and lastly, goodwill. Following the accounting equation assets minus liabilities equals equity, the sum of consolidated common stock, consolidated APIC, and consolidated retained earnings should be equal to consolidated total liabilities minus consolidated total assets. Let's go back to this problem and solve for the consolidated common stock, APIC, retained earnings, total liabilities, and total assets on the date of acquisition using the memory aid Carla 23434. For consolidated common stock, we first take the common stock of the parent, that's 720,000. We then add the par value of the common stock issued, that's 30,000 times 10, 300,000. Hence, the consolidated common stock on the date of acquisition is 1,020,000. Next is consolidated APIC. We first take the APIC of the parent, that's 240,000. And then we add the APIC from issuance of shares, that's 25 minus 10 times 30,000. That's 450,000. And then we deduct share issuance costs. That's 18,000 plus 14,400, 32,400. Hence, the consolidated APIC on the date of acquisition is 657,600. Let's now proceed to consolidated retained earnings. We first get the retained earnings of the parent, that's 264,000. We then deduct direct and indirect acquisition costs, that's 12,000 plus 24,000 plus 42,000 plus 27,600. That's a total direct and indirect acquisition costs of 105,600. We then deduct the excess of share issuance costs over APIC. In this illustration, we do not have excess of share issuance costs over APIC because APIC is more than sufficient to absorb the share issuance costs. Hence, this is 0. Moreover, in this problem, we have goodwill instead of gain on bargain purchase. Hence, gain on bargain purchase is also 0. The consolidated retained earnings on the date of acquisition amounts to 158,400. Let's now have consolidated total liabilities. We first get the liabilities of the parent at book value. That's 216,000 plus 240,000, 456,000. We then add the liabilities of the subsidiary at fair value. That's 72,000 plus 168,000, 240,000. For liabilities issued, we have notes payable of 180,000, and contingent consideration of 120,000 times 30%, 36,000. Total liabilities issued is 216,000. Hence, the consolidated total liabilities on the date of acquisition is 912,000. For consolidated total assets, we first take the assets of the parent at book value. That's 1,680,000. We then add the assets of the subsidiary at fair value. That's 1,104,000. Next, we deduct the cash paid as part of the consideration transferred and cash paid for acquisition costs and other costs. In this illustration, we do not have cash as part of consideration transferred. However, we have cash paid for acquisition costs. That's a sum of 12,000, 24,000, 42,000, 18,000, 14,400, and 27,600. That's total cash paid for acquisition costs of 138,000. Lastly, we add goodwill, which we have computed earlier as 102,000. Hence, the consolidated total assets on the date of acquisition is 2,748,000. When we add consolidated common stock, consolidated APIC, and consolidated retained earnings, the sum should be equal to consolidated total assets minus consolidated total liabilities. 2,748,000 minus 912,000 is 1,836,000. This should be equal to the sum of consolidated common stock, APIC, and retained earnings. Let's check. 1,020,000 plus 657,600 plus 158,400, that's also 1,836,000. The memory aid Carla 23434 is very useful in multiple choice quizzes so that you don't have to actually prepare the consolidated balance sheet in order to compute for the consolidated balances. Let's take a look at another problem. You may pause the video to read the problem thoroughly on your own. Here, we are required to compute for goodwill and to prepare the journal entries in the books of the acquirer. First, let's compute for consideration transferred. The consideration transferred consists of cash payment amounting to 18 million, shares 50,000 times market value of 80 pesos, that's 4 million, and contingent consideration of 400,000. The total consideration transferred is 22,400,000. Next, we compute for fair value net assets. We are given the fair value of the assets of the acquiree, and aside from these assets that are already in the balance sheet, we're also given additional intangible assets, namely brand names and security formulas. We add this to the assets already included in the balance sheet. Hence, the fair value of the total assets of the acquiree is 63,280,000. And then we deduct the liabilities, minus 400,000 and minus 47 million from the 63,280,000 to get the fair value net assets of 15,880,000. $22,400,000 minus 15,880,000. Goodwill amounts to 6,520,000. Let's now prepare the journal entries in the books of the acquirer. This is an acquisition of net assets. Hence, we debit all the assets acquired, credit all the liabilities assumed, and credit as well the consideration transferred. The assets acquired are the following: cash, 90,000, receivables, 190,000, inventories, 7 million, plant and equipment, net, 40 million, trademarks, 4 million, brand names, 5 million, secret formulas, 7 million. The liabilities assumed are current liabilities, 400,000, long-term liabilities, 47 million, and and estimated liability for contingent consideration $400,000. We credit also the consideration transferred consisting of cash, 18 million, credit also common stock for the par value of the shares, 50 million times 2 pesos par value, that's 100,000. Credit also share premium or APIC for the excess of the market value over par value, that's 80 pesos minus 2 pesos times 50,000, 3,900,000. The balancing figure of this journal entry is a debit to goodwill, 6,520,000. Next, we record the acquisition-related costs. Registration fees connected with issuing the new shares. This is share issuance costs charged to APIC. Cost of issuing and printing shares or stock certificates. This is share issuance costs charged to APIC as well. Consulting professional fees paid to brokers. This is direct cost, expensed outright. Legal fees, audit fees, and finder's fees for acquisition. This is also direct costs, expensed outright. To record the direct costs, we debit acquisition-related costs, and credit cash for 1 million plus 100,000. 1,100,000. To record share issuance costs, we debit APIC and credit cash for 300,000 plus 200,000, 500,000. And those are all for the first requirement. Let's now take a look at this independent scenario. Here, we are given another additional intangible asset, which is a non-competition agreement with a fair value of 10 million. Previously, our total assets at fair value was 63,280,000. But with the non-competition agreement included, this brings our total assets at fair value to 73,280,000. We deduct current liabilities of 400,000 and long-term liabilities of 47 million to get our new fair value net assets of 25,880,000. With this, instead of goodwill, we now have a gain on bargain purchase amounting to 22,400,000 minus 25,880,000. That's 3,480,000. The journal entries are exactly the same as the last scenario, but we have an additional intangible asset, which is the non-competition agreement, and instead of a debit to goodwill, we instead have a credit to gain on bargain purchase, 3,480,000. Let's now compute for the consolidated total assets, total liabilities, additional paid-in capital, retained earnings, and shareholders' equity on the date of acquisition. Again, we'll be using Carla 23434 to compute for the consolidated balances. Let's start with consolidated common stock. First, we take the common stock of the parent, which is 2 million. And then we add the par value of the common stock issued. That's 50,000 shares times 2 pesos per share, 100,000. This gives us a consolidated common stock of 2,100,000. Let's now proceed to consolidated APIC. The APIC of the parent is 55 million. The APIC from the issuance of shares is 80 pesos minus 2 pesos times 50,000. That's 3,900,000. Again, this is computed as 80 minus 2 times 50,000. Share issuance cost amounts to 300,000 plus 200,000, 500,000. The consolidated APIC is 58,400,000. Next is consolidated retained earnings. Retained earnings of the parent is 25 million. Direct and indirect acquisition costs amounts to 1 million plus 100,000, 1,100,000. Excess of share issuance costs over APIC is 0 since APIC is sufficient to absorb all of the share issuance costs. And gain on bargain purchase is 0 based on the first scenario. Hence, the consolidated retained earnings is 23,900,000. Next is consolidated total liabilities. The liabilities of the parent is 70 million plus 500,000. That's 70,500,000. The liabilities of the subsidiary at fair value is 47 million plus 400,000. That's 47,400,000. And the liabilities issued consists of the estimated liability on contingent consideration, 400,000. Consolidated total liabilities is 118,300,000. Lastly, let's have consolidated total assets. Assets of the parent at book value is 151,500,000. Assets of the subsidiary at fair value, as computed previously, is 63,280,000. This consists of the assets already in the balance sheet plus brand name 5 million and secret formula 7 million. These add up to 63,280,000. Cash paid as part of consideration transferred and cash paid for acquisition costs and other costs consists of 18 million. That's the cash paid as part of consideration transferred plus the total acquisition related costs of $1,600,000. Hence, total cash paid is 19,600,000. And goodwill, as previously computed in the first scenario, is 6,520,000. Consolidated total assets is 201,700,000. Consolidated total assets of 201,700,000 minus consolidated total liabilities. This gives us 83,400,000, which is our consolidated stockholders' equity. To check, we add consolidated common stock, consolidated APIC, and consolidated retained earnings. The sum of these three is 84,400,000. Observe that there is a 1 million difference, and the 1 million difference is attributable to treasury shares of 1 million. So from the 84,400,000, we have to deduct treasury shares of the parent, 1 million. And this gives us 83,400,000, which is equal to consolidated total assets minus consolidated total liabilities. Step 3 of the acquisition method also involves the recognition and measurement of identifiable assets and liabilities of the acquiree. In accounting for business combinations, we follow the general asset recognition principle for identifiable tangible assets. Tangible assets are those assets with physical form that can be seen, touched, or felt. For identifiable tangible assets in business combinations, again, we follow the general asset recognition principle, which states that we can only recognize an asset if it's both probable and measurable. However, in accounting for business combinations, identifiable intangible assets are a departure from the general asset recognition principle. For identifiable intangible assets, or those assets that do not have a physical form, in business combinations, we are able to recognize them even if they are not probable, so long as they are identifiable. They are identifiable if they meet either the separability criterion or the contractual legal criterion. Examples of intangible assets that are considered identifiable because they meet the separability criterion are as follows: customer and subscriber lists, depositor relationships, registered trademarks, unpatented technical expertise, favorable operating leases, licenses, and technology patents. Observe that under business combinations, the criteria for recognizing intangible assets is much more relaxed compared to normal accounting. Under normal accounting or outside business combinations, we don't normally recognize customer and subscriber lists and unpatented technical expertise as assets because they do not meet the probability and measurement criteria. However, under business combinations, we can already recognize these as assets because they are identifiable. Hence, there are intangible assets that we can already recognize under business combinations that we do not normally recognize under normal accounting or outside business combinations. An example of an intangible asset that is considered to be identifiable because it meets the contractual legal criterion is a license to operate a nuclear power plant. To reiterate, in normal accounting under Past 38 intangible assets, an intangible asset is recognized only if it meets the following criteria: identifiability, probability of future economic benefits, and control over the future economic benefits. However, under business combination, we only need to meet the first criteria in order to recognize an intangible asset. If the acquirer is still uncertain about the fair value of some items on acquisition date, the acquirer may use provisional amounts which can be changed later. However, the measurement period shall not exceed 1 year. Hence, after 1 year, the amounts can no longer be changed. Let's now take a look at this problem. You may pause the video to read the problem thoroughly on your own. The first requirement is to determine the amount of goodwill. To compute for goodwill, first we compute for consideration transferred. In this problem, consideration transferred consists of shares with a market value of 700 million and contingent consideration with a present value of 50 million. Hence, the total consideration transferred is 750 million. Next, we compute for fair value net assets. We are already given the assets and liabilities of the acquiree at book value. We're also given information in relation to the market values of these assets and liabilities. According to the problem, inventories are overvalued by 200 million. Overvalued means that fair value is lower than book value. Hence, the fair value of inventories is 600 million minus 200 million, that's 400 million. Moreover, PPE is overvalued by 200 billion. Once again, overvalued means that fair value is lower than book value. Hence, PPE fair value is 7.5 billion minus 2 billion, that's 5 billion 500 million. In addition, long-term debt is undervalued by 100 million. Undervalued means that fair value is higher than book value. Hence, the fair value of long-term debt is 7.2 billion plus 100 million, that's 7.3 billion. The following items are not currently reported on Sandy's balance sheet. Customer contracts valued at $25 million. Under normal accounting, customer contracts do not qualify for asset recognition. However, under accounting for business combinations, we can already recognize customer contracts as asset. Hence, customer contracts is included in the acquiree's net assets. Next is skilled workforce valued at $45 million. Under both normal accounting and accounting for business combinations, this is not recognized as asset. We also have in-process research and development valued at $300 million. Under normal accounting, research costs are expensed outright, while development costs are capitalized only when technical feasibility has been established. Generally, under normal accounting, in-process R&D does not qualify for asset recognition. However, under accounting for business combinations, we can already recognize in-process R&D as asset. Hence, in-process R&D is included in the acquiree's net assets. Next is potential contracts with prospective customers valued at $15 million. Under both normal accounting and accounting for business combinations, this does not qualify for asset recognition. That's because the contracts have not yet been obtained, as they are potential contracts only. Lastly, we have unrecorded expected future warranty liabilities with a present value of $10 million. This is a contingent liability. Under normal accounting, we can only recognize a contingent liability if it is both probable and measurable. However, under accounting for business combinations, even if a contingent liability is only possible, we can already recognize it so long as it is measurable. Hence, expected future warranty liabilities is included in the acquiree's liabilities. The fair value net assets is therefore computed as follows. Cash and receivables, $200 million. Plus inventories, $400 million. Plus PPE, $5.5 billion. Minus current liabilities, $400 million. Minus long-term debt, $7.3 billion. Plus customer contracts, $25 million. Plus in-process R&D, $300 million. And lastly, minus expected future warranty liabilities, $10 million. The fair value net assets is negative $1,285 million. $750 million minus negative $1.285 billion. Goodwill is $2,035 million. Observe that we added fair value net assets to consideration transferred. That's because this is a double negative, and double negative makes positive. Let's now proceed to the second requirement. Assume that during March 20X5, which is just 3 months after the acquisition date, new information comes in regarding the value of Sandy's PPE at the date of acquisition. It is determined that the property was actually worth $1.5 million less than previously estimated. Make the entry to record this new information. To decrease the value of PPE, we credit PPE by $1.5 million. Now, since the change is due to new information regarding the value of Sandy's PPE at the date of acquisition, and the change is within the 1-year measurement period, the change is adjusted to goodwill. Hence, we debit goodwill for 1.5 million. Previously, we have computed goodwill to be 2,035 million. But with this adjustment, goodwill is now 2,036,500,000.